Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me live from MarketSite, as he does for the third Monday of each month, is Robert Yawger. He is the senior energy analyst over at Mizuho Americas. Thank you very much for our monthly update. And things continue to keep moving within the space. So what are your thoughts on the pace of production growth right now?
Production growth is ripping. I would have not thought it could be this strong for this long, but we continuously put in new all-time records. The thought that the United States could be producing at 11 million barrels, I did not think it was possible. First of all, because of just technical reasons, bringing the crude oil out of the ground, I didn't think it was doable. I do think it is now. Also, I thought the closer you got to 11 million barrels, the more it would put pressure on prices, which may ultimately end up being the case, but we continue to trade in a range of about $60 to $65, that $5 range right there, as production continues to expand. So obviously that is a function to a certain degree of OPEC cutting back on production. We are filling the space that we are taking advantage of the opportunity that OPEC presents to us, as us being the United States. But if that equilibrium continues to pan out, we're going to get to 11 million barrels possibly this year.
Are you concerned about oversupply? Is there enough demand out there to strike that balance?
Well, that's debatable. That's highly debatable. You can see in the curve for WTI today, crude oil is trading about $62. But if you go out to December, it's trading in the 50s. So there is a slide. That is a market that's telling you that they are concerned that eventually price oversupply will start to weigh on prices. So yes, I am concerned. The market is telling you should be concerned, and I would buyer beware at the end of the day.
Well, more near term, we're coming into the summer driving demand season, particularly on the East Coast. What are your thoughts in terms of crude and gasoline prices?
Well, gasoline last week, the Wall Street Journal keeps track of the 70 best performing currencies, ETFs, indexes, and commodities. Gasoline was the second best performing instrument last week. And it very well should have been. In the EIA report last week, the gasoline demand for this time of year was the highest since 2007. Actually, it was product demand was the highest since 2007. So refineries, they still have to crank out the gasoline and to a certain degree distillate also to keep up with demand. And they can't afford to really lower their refinery utilization rate all that far. In the process, they're ripping through a whole lot of crude oil. An unprecedented amount for this time of year. So crude oil demand as a function of refinery runs is actually very high, and product demand is also very high. Now, gasoline demand is high for one big reason, because the price is cheap.
Right.
Now, if the price goes higher, that may no longer be the case. There will be a law of decreasing demand at that point. But yes, as of right now, it is holding par. It's an incredible story.
Well, let's look even more macro than that. Do inflation concerns impact your outlook at all?
They do, but sometimes it's also the energy space that creates the inflation situation too. So in my opinion, if we can continue to trade crude oil at around, below $2, energy will not contribute to a high price for an inflationary environment. We blow through $2, it will be the case. Once you blow through to $2, it starts to become in my opinion, a hang on the economy. And I guess at that point it becomes an issue with the Fed too. The likelihood of them increasing interest rates because energy forces the inflation rate higher becomes a real possibility.
We'll find that out on Wednesday too.
We'll find out on Wednesday. Now, interest rates as a function of interest rates is not all that bad of a thing for energy. But if energy is the thing that forces the hand, that's a different story.
All right, and to wrap up, there's always geopolitical catalysts that you have to pay attention to as a crude trader. What's on your radar?
Well, we have Mohammed bin Salman. He's going to visit the White House tomorrow. If he comes out with any kind of headline, if there's any kind of public headline that comes out of that meeting that has to do with Iran, or even worse yet, if anything comes out of that, I shouldn't say worse, but if a headline comes out of that meeting that says that Trump is going to pull the plug on the May 12th Iran deal, it's the Iran deal that's up for review on May 12th. If he says he's going to pull the plug on that and he's in some kind of alliance or something with the Saudis, who are basically do not get along with the Iranians at all, that's a market rallying event that could easily happen. It seems like President Trump is determined to pull the plug on the deal. I'd give it probably an 80% chance, maybe even a 90% chance they pull the plug on that deal. that will be a market rallying event when it does happen. And it implies a certain amount of Iranian barrels will go off the market.
All right. Well, thank you very much for joining us. We'll catch up with you in April. All right.
Thank you.
And traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.